Welcome back to another episode of What's on Your Mind. Joining me on the show today, I've got Raj Malhotra and Anthony Iser. Gents, it's good to have you back on the show.
Thank you, Chris.
Um,
Thanks,
we were
Chris.
we were just discussing offline. Actually, we'll get straight into it. We were just discussing offline, Raj, about the current bearish consensus in the market. So why don't you kick it off for us today and just share some of your thoughts on that?
Yeah, well, it's funny if you go around New York or the hedge fund community, or all, whether it's retail investors or investor at the top, the whole market's either bearish or they're looking for a pullback and then want to buy, or they're calling for one more rally and then a big sell-off, or just a straight big sell-off. What happened to all the What happened to all the bulls? What happened to the guys that are straight up bullish? Now, it's funny, and a lot of the data, some of the data is weakening, but usually when consensus is so far one way, the opposite happens. And I'm not saying we're going to get a 30% rally till the end of the year, but I don't actually quite. If you look at the granular data in the U.S., like versus the rest of the world, given that long-term rates are just continuing to go lower, and that's pretty clearly a fact. It's hard to get really bearish on the U.S. given that they still have positive yield and positive GDP growth. There's clearly sectors of the market that are underperforming, but money's got to go somewhere, and money's going to flow in from the rest of the world to the U.S. given where 10-year rates are in Europe and Japan and the rest of the world. Once that money comes to the U.S., getting some kind of positive yield, it's easy to invest it in other assets, namely real estate and much easier stocks. And there's clearly pockets of this economy that are really strong, unless of course Elizabeth Warren wins, then throw the whole playbook out. We can talk about her another time, because if you want to raise $25 billion for Medicare for all and confiscate the top 1% of people's wealth, you still won't have enough to pay for it. So let's throw that one out for a second. But having said that, and if you read the news, everything's negative on Trump. He's going to be impeached. He's going to be thrown out. I've heard this story for 3.5 years. If you look at the data is strong. The economy is still pretty strong here. I go around, real estate prices are a little softer, but in a relative sense, everything is good. And I really don't. And I really, I think a lot of people are going to miss this rally because everyone's looking for the better entry point. And if you just believe that stocks are going higher, which I kind of think that there are certain pockets of this market that are poised to go higher. You just have to be in them and use market weakness as a way to initiate positions, especially when it's not specific to your companies, such as it's happened a few times this week when every time there's a trade war or whatever. But there are certain sectors, such as like in healthcare, which I think there are tremendous bargains, and there will continue to be those until sentiment changes all around.
So what sort of pockets of the market are you looking at for this episode?
Well, I'm still bullish on. I'm bullish on a lot of, like I said, in healthcare, biotech. There's certain names that I really like there, and in terms of where I'm bearish, I'm bearish on basically anything with high overhead, anything that has much more of a global. It's globally based, like transport, for example. And I can go over those now, or we can kick it over to Anthony. I haven't talked. He was supposed to see me in the U.S., guys, but he never showed up. So it's good to see his face.
Thank you, Raj. Yes. Just had 3 weeks on the East Coast, and apologies, Raj, for not coming up for a game of golf. But you're right. I mean, everyone is pretty negative at the moment. And at the moment, the companies that have reported through this results season, 82% of them have been above expectations. Normally, that number's about 65%. So things are, either going quite well or they're just managing expectations a little bit better. And it could be the latter. But yeah, everyone's sort of looking at a one-way street on the way down at the moment. So while I was in the US, I spent a long time analysing the food market. I think I put on about 4 or 5 kilos in 3 weeks. And so many of those were listed food companies, thankfully. So at least I've got some research done out of it. And Chipotle isn't in Asia, and I'm sure they'll look to expand here at some stage, but I gave that a fair run once or twice. And they've just reported as well. So it's an interesting company beyond their delicious treats. So this is a company, for those that don't know, it's $22 billion market cap. It's very strong earnings growth, 48% and 30% the next couple of years. And as a result of that, the market trades at a premium. PEs of 71 and 50 for the next 2 years coming up as well. And the stock has done incredibly well, up near enough to 100% this year. 580, 558, something like that was the high. Stock's trading around about 788 after the result. And just to talk about that result, which was just last week, it was an absolute cracker. Margins were up 210 basis points, revenue up 15%, EPS up 77%. And this is, I guess, this is the expectations people had for something like this because the share price has been so strong this year. And same-store sales were better across the board. But despite that, they still managed to beat expectations. The market rated them up, but they still beat revenue growth by 1.5% and earnings by 20%. So the new CEO, he's been there about 18 months now, Brian Nichols. He took over when they had a big food scare in 2018, and the original founder and CEO stepped down. And he's done an absolutely cracking job since then.
So, I mean, looking at the chart, it's gone down, hasn't it, since that result?
Yeah, you're right, Chris. And that's the interesting thing that's going on with results at the moment. People probably are being, so some of them are a little bit more confusing. Some of them people are being a little bit more discerning. It is taking some time to determine what the market is looking for in some particular companies. And in this case, obviously, when you're trading at a big premium to the market, like they are, they're trading at sort of 2.5 times the multiples of the big names like Yum Brands, McDonald's, and Jack. You can't afford to sort of disappoint. And so despite all those strong earnings numbers, revenue numbers and same-store sales numbers, they did say that they're going to be slowing down their expansion in 2020. Now, it's for quite a good reason. Their store rollout, they're slowing down a little bit because they are putting drive-thrus in a lot of their stores, which historically they haven't had. And the reason they're doing this is they've done a bit of a test run and the numbers have shown up to be very, very good. So they're keen on rolling that out a bit more rapidly. But the counterbalance to that is the new stores are going to slow a little bit. And that seems to be what people are a little bit worried about. At the same time, when you trade on a big premium and you disappoint, you can get knocked around. So there could be people as well just saying, look, you're up 100%, you trade at a big multiple relative to everyone else, we'll just take a little bit off the top. And I guess that's a fair enough reason at this point in time. So my view would be here, let's just see if the stock stabilizes. I think it's still a fantastic company. If this 5% decline is sort of about it on the back of the result, I'd be looking at buying it for the next 3 months through the result. You might see, as Raj mentioned, those rate cuts, quantitative easing would be very targeted towards the consumer. So these consumer discretionary restaurant names would do very well in that environment.
Yeah, so more of a stock being down is more to do with a sort of consolidation perhaps, or taking profits than necessarily bad fundamentals.
A component, there's a component to that though. But yes, when you trade at a premium, you can't afford to disappoint in any area.
Mm-hmm. Let's switch it back to you, Raj. You mentioned some transportation potential ideas earlier.
Yes, so one stock that I'm pretty bearish on, I've been in it for a while, then I continue to dislike is FedEx, Federal Express. Market price, the stock's down about 30% this year, but I think there's still a lot more room for it to go down. They pre-reported in September. They expect a negative 22% earnings growth this year, which is pretty shitty all around. Let's be honest. And next year they're calling for like a 13% earnings growth increase, another 13% in 2021, and let's just say those are pipe dreams. I think they've had too much legalized cannabis, if you believe those numbers. And let's go through why I believe that. First of all, one thing in terms of like price pressure here, FedEx has always been a darling of the hedge funds. Hedge funds have always, this was the big cap name that a lot of hedge funds liked, and they've just been wrong. So, and I think there's still a lot of liquidation to go as they continue to miss. A little known fact about hedge funds are they're good at usually picking smaller names. They've consistently underperformed and been bad at picking larger cap names, and FedEx qualifies here. FedEx actually basically told all their employees that they're getting no bonuses for 2020, and I think and they've already basically told their employees they're not going to get bonuses for 2021. Now, while the market might like those cost-cutting measures, you just cannot cut your way to profitability, especially in a name, especially in a company that relies on very high overhead. Obviously, all their planes and trucks and whatever, but more importantly, a business where services like that customers expect, you just cannot, like on-time delivery, you just cannot cut back on that. You cannot just go as a customer of FedEx, and when you expect 1-day delivery, now just say, oh, we're not going to do that anymore. We're going to offer 3-day delivery. Customers are dicks. Let's be honest. Customers are not going to just accept 1-day delivery, 3-day delivery after always expecting 1-day delivery. And if that opens them up to competition from places like Uber and certainly from drones. So I just don't see how this business model survives as cutting back services and without really cutting their overhead. And with a 90 PE, it just priced for tremendous growth, which is just not going to be there. So the big problem with FedEx is here. Number one, it's a global economy slowing, and this company is very affected by that. I mean, they've struggled tremendously over the last year. Like they've told all their employees they're not getting bonuses this year, they're not getting bonuses next year, and you can't cost cut your way to profitability, especially when the cost cut that you need is high overhead transport, planes and drivers and all that other overhead. And customers just will not accept a shittier product in delivery. If they're used to 1-day delivery or 2-day delivery, you can't just say now we're going to go to 4-day delivery. If they do that, then companies like Uber or Lyft can actually pick up some of the slack there. And and plus the obvious competition from drones as drones become better. Drones will replace FedEx in a lot of delivery. I mean, and it's actually on a side to this, someone told me the other day, my brother's dumb. What should I tell him to do? And I'm sure a lot of you guys have dumb siblings and friends. Tell them to go learn how to fly a drone. It's basically like playing a video game, and you'll get paid. And that's something that the economy will need 10, 15 years from now. So, but anyway, back to FedEx. I mean, they just cannot at a 90 PE. With a negative growth rate and really no way for me to really there's no real technological product that they're going to change, and they're not really embracing the drone technology. I just don't see how you can justify this PE, and I think there's tremendous there's a potential for much more downside from here.
Mm-hmm. So what would you be thinking on the other side of that, or is that sort of a lone short?
I mean, if you really want to play on the other side of it, I would look at UPS. I mean, UPS is quite the opposite, actually, if you look at FedEx. UPS just reported the other day, UPS has a PE ratio of 20. FedEx has 90. Now, generally we talk about we'd rather own higher PEs, but those differences are huge. And let's face it, nobody has brand loyalty to UPS or FedEx. I could give a shit if I get it from UPS or FedEx, as long as the box gets there on time. UPS it's funny. If you look at their earnings report the other day, UPS gave the market everything FedEx didn't, and that wasn't enough. The stock still sold off. They had better reported earnings. They maintained their full year profit outlook. I mean, granted, that a slight revenue miss because of trade war, but they were still they were ahead of their earnings issue, as opposed to FedEx that just totally whipped. I mean, FedEx guidance was brutal, and UPS did everything. They trimmed their capital budget by $500 million this year, and that's supposed to boost cash flow by $4 billion next year. They did everything right. and it was just the market still didn't care. I mean, FedEx is burning. If you look at FedEx, look at them; they're burning cash in fiscal 2020, and Moody's actually cut their credit rating. Yeah, so FedEx is still burning through cash, and UPS is being prudent, and I just can't understand why UPS was sold off, given they're doing everything right, and at a PE ratio of 20 versus FedEx is at 90, and as FedEx continues to burn through cash, if you wanted to play, in my opinion, as a safer way, I'd much rather own UPS than FedEx here.
And is there a particular sort of way or structure you've thought about setting that up with UPS?
Yeah, I mean, in UPS, I haven't really structured it. I don't think the option play makes too much sense because I think it's going to be if you put this trade on as a pair, if you had to put a gun in my head, I'd say, well, UPS will probably be around flat and FedEx will be the one that will sell off. So if I'm looking at FedEx and an option strategy, I looked at the December 155, 130 put spread. They report before December. If you look at the 155, 130 put spread, you can pay $5.80 to make $19.20. And that's like a 3.3 to 1 payoff. And that's simply for the stock to drop 15% from here. I mean, again, like I said earlier, it's down over 30% this year already, but still at a $40+ billion market cap. You know, to go down 15%, it'd still be above 30 billion. And I really think that if FedEx is smart, they'll make it a turnaround story next year. And if they do that, they'll just kitchen sink everything at the end of this year. They'll just throw all the bad stuff, all the bad numbers, all the write downs into this number at the end of the year. And then you'll get the sell off, and then you'll get the relief rally. If they don't do that, it'll take a while for the stock to recover. I mean, it takes a long time to turn around a rotten story.
Speaking of rotten stories, then, Anthony, let's jump back to you. Within the food theme, is there anything that's sort of jumping out to you that doesn't look great?
Well, Chris, yes. I mean, this isn't a rotten story as such. This was the company that put the most kilos on my waistline while I was on the East Coast. And Shake Shack. Fantastic burgers. I know people on the west coast of the US would say In-N-Out Burger would be better, and everyone's got their little, Five Guys and boutique numbers. But for a company that is listed and expanding, they were cracking burgers, I must say. But there's a difference again between eating the burger and buying the company. So yes, this is one that I think you can learn something from this Chipotle result, which was broadly good across the board, spectacular in some parts, but disappointing just on a couple of areas that the market was concerned about. And that could play out for Shake Shack. And so the opportunity we've got here is to look at that result, look at Shake Shack and say, okay, it's reporting next week. What can we learn about the risks, and is the risk to the upside or the downside? And I think it's to the downside. So this company's a lot smaller, $3 billion market cap. Recent 52-week high was $108. It's drifted back down to 84 or so, 84.5 at the moment. It's got negative earnings growth. People are very focused on the store rollout and top line growth. So it's negative earnings growth this year, 17% next year. It's trading on a PE of 140. Now, that's pretty punchy, but again, people are focused on other components of the growth story, not the earnings at the moment. That said, if it disappoints, it will get absolutely belted. And it hasn't disappointed so far. This year, it's up 6% and up 18% on its results. And it's continued, historically, it's done the same thing. It has exceeded expectations. So they're rolling out these new stores, they're expanding overseas. And one of the issues I'm seeing with that is the per store sales are dropping each time. So they've gone from about $5 million per store when they're in New York. As they expanded out, that's dropped. It's $4.3 million per store at the moment. It's dropping to $4 million. And some of that may be to do with their ability to roll out the quality across the board. They are in Singapore here. It's a different model overseas. They have a bit of a franchise model. And I must say, having gotten back I was pleased that they were here in Singapore. I went and tried it, and it wasn't as good. And if you look at the big names in this global fast food world, if you buy a Big Mac in Australia, Singapore, Washington DC or London, it's the same. You wouldn't be able to tell the difference. And so you need to get that quality the whole way through. And that may be one reason why these same store sales are dropping off a little bit, that people sort of can't quite see what the fuss is about when compared to the original New York offering. And so the other issue with growth, and this is where I think they could continue to disappoint, they have same store sales growth. Now there's two ways you can get growth out of the same stores that you had last year, or in their case 2 years before, because they need stores open 2 years before they would include them. You can get higher prices or higher foot traffic. Higher foot traffic's a better option, a better quality. And unfortunately, foot traffic's been going down, and they've been getting growth from higher prices. And you can't keep putting prices up consistently on a regular basis, and it disadvantages you versus the competition. So preferences for foot traffic, which is going down. So yeah, it's at risk. It's a quality offering that they've got, but at 144 times, you can't afford to make a mistake. And I think there's a risk that they might. But I wouldn't be outright shorting it, because they have consistently outperformed, and there is another risk that it's been a very strong summer in the US. The weather's been great. This is a very seasonal business and local business at the moment, broadly focused in the northeast of the US. So that good weather could drive sales onto the upside as well. So I'd be looking at doing it via the options market. Now, Raj would let you know that these high implied volatilities make it a lot tougher to get a return, and the implied volatilities are high at the moment for Shake Shack. But that said, the stock's about 84.50 or so at the moment. You can buy at the money puts for $4.50. So you're looking at $79.50 to make money. That's about 5% down. I suspect if they disappoint when they're trading on 140 times PE, they could be down a lot more than that. So that's the way I'd play it. It's been a very good performer, up massively this year to its all-time highs, and it's just eased off a bit. And I guess that so some people out there do have a bullish view on Shake Shack. And I can see the reasons why, but I don't agree with them all. But if you wanted to have something on the upside as well, there are out of the money calls, your sort of $90 calls that you can pick up for $2. If you wanted to have a strangle, you could put both of those on. Your trade, you'd be profitable below 77.50 and above 92 or so if you did that. That's probably the way I'd play it, but I'd prefer to risk to the downside and look somewhere else for something on the long side. Yeah. And Chipotle, if it stabilizes here, would be that name.
Yeah. First of all, I was saying you're right about in terms of like applied volatility. Anytime vol's high, don't confuse it with cheap. I do think that. So I'm more of a buyer of options when vol is high, because it's high for a reason and low for a reason.
Yeah. Okay. Oh, that makes sense.
And I absolutely think Shake Shack is a short. So and you look great with all your Big Macs, by the way. So it's speaking of healthcare that you probably need because of all those Big Macs you have. I want to talk about a name. Excuse me. This is a name that if you follow the type of names that I pitch, this is a little bit unusual for me, because this to me was more of a value name. When I first bought it, it's Biogen. I bought it a few months ago after they were working on a Alzheimer's drug, and basically they basically said it wasn't working and the data wasn't going to work. So the stock went down to around below 240. Like, I think I bought around 235 or so, and around there it's about a PE of 8. The other day, some data came out that they said that the drug that they were working on for Alzheimer's, some data came in that said that it might be able to basically work again. And it's with new data. And basically, the FDA did something unprecedented. They basically allowed them to continue working on that a day after the data came out, which is usually that takes months, many months for them to happen. So the stock went up to 275, and the reason this is not a name that I normally talk about is it's not projected for a lot of earnings growth next year. It's a pretty flat earnings growth. But having said that, I liked it as in the mid 230s, this safe stock with really no downside. I thought the stock with a PE of 8, there's no downside, and I really thought that with abandoning the Alzheimer's drug trials, with the amount of cash they had, they could go buy another biotech company. Maybe a name like Seattle Genetics, SGEN, that just came out with a breast cancer, where they think to develop a breast cancer drug. But now with this drug, Alzheimer's is a disease that affects so many people around the world. And granted, this drug is not expected to just cure Alzheimer's or get rid of it altogether. It's expected just to slow the effects of Alzheimer's. And the contrary to that is some people are saying that, okay, well, it's going to be expensive. You're just allowing people to live longer and driving up healthcare costs. But I don't buy that shit at all. I think that if people if their grandmother has Alzheimer's and they can slow the effects of Alzheimer's, people are going to spend it. So I don't buy that argument at all. Now, in terms of trade structure, I do think, of course, as with any drug, just because the trials have been reinstituted, it doesn't mean, and there is some, and they're pretty optimistic of what this drug will do. Again, there's risk that, again, it just turns around and they say it doesn't work again. And I'm very mindful of that. So the trade structure that I really like here is, if you look out to June, which should give you enough time to have some of the results of this drug trial, if you sell 2 of the June 230 puts and buy 1 of the June 300 call, you can get that on for around 0. So think about it like this. If the stock goes back, if everything bad happens, stock goes back to basically where it was a month ago, or I should say about a week ago, you still are above your strike. And even if you end up buying your stock at 230, that's below 8 times earnings for a big biotech company that has the money to buy other companies and other drugs and develop that. So if that's your downside, I'm fine with that. And and you're long the 300 call, if everything goes well, this stock could be a $400 stock. So I think I love the risk reward of that trade, and that's how I'm playing it.
Cool. Were there any final things you wanted to mention on your side, Anthony?
Well, Chris, I mean, there was probably about 40 other places I ate while I was in the US, but I will stick with the listed ones rather than the small little restaurants. So yeah, I will just mention a couple before I go. McDonald's is obviously the global behemoth in this world, and if you're looking for a great burger, you go to Shake Shack. If you're looking for a defensive stock that, as Raj just said, probably doesn't go down, or if it does, it's certainly going to go down much less than anything else in its sector. And McDonald's is that name in this sector. It's $122 billion. It's got 10% growth over the next couple of years. It's trading on 25 times. And again, as Raj mentioned earlier, this is not the standard sort of stock that we would be looking at within this sector at the Institute. Chipotle would be the standout name. But in this macro environment, stock pickings are sort of all the more important. And so if you're looking for something a bit more defensive, it's the one to go to. And particularly if QE kicks in again, which targets the consumer, you'll see spending in this area. So I'd have a look at that. One that I didn't participate in on the food tour, but it's one that we've talked about 3 or 4 months ago, Beyond Meat, which we suggested selling at the same time as the insiders were selling in the capital raising that was done in August. The stock was $177 then. It's $98 now. So for those people who got involved, it's gone particularly well. And so I've been getting a bunch of questions on whether we sort of close that out or what we do with the stock at these prices. And I suspect that you just keep that on, and you could possibly open new positions as well. It's still a $6 billion company. That's twice the size of Shake Shack, and they've got $100 million in revenue each year at the moment. It's if you go back to sort of the early part of last century, there was hundreds, if not thousands, of companies that made airplanes, and now we've got 2 globally that participate. Ultimately, it will be the same with these plant-based protein or lab-grown protein. Down the track, you will wind up with just a couple of these companies, and the growth in competition is really coming through now. So the combination of that growth plus the declining interest in Beyond Meat and its products, and I still haven't found anyone who's ever had 2. I've had plenty of people who have tried it. I've not found anyone that's said, yeah, I'm going back for more. So if you just do a Google interest search, and Chris, maybe you can put one up for the viewers after this, you'll see it continues to decline. And that's been what drove the share price on the way up, and I suspect it'll drive it on the way down. And then, yeah, just before I go, I guess markets are pretty tough at the moment. As we've talked about, the macro is particularly tough. So stock picking skills are important, and we need to focus on those types of things. And this rotation is underway. So we are seeing some selling of the super high growth stocks as they disappoint, a little bit more interest in earnings and sort of mid-tier and lower tier PE stocks as well. Again, as Raj and I have just talked about. So look for earnings and focus on earnings at the moment. And I guess the other thing is, we're trying to avoid mistakes. So the options positions that Raj has spoken about and some of the ideas I've talked about are structured in a way that you are not going to blow yourself up. And that's particularly important at this point in time. So, yeah, that's probably about it from me, Chris.
Yeah, absolutely. And it's worth mentioning on that note that we do have courses on options available on our website. So for you guys watching, if you're interested in learning more about implementing trade ideas using options, then you can take that course that we have available on our website. All right, guys, thank you for your analysis this week. It's been great to hear some more intra-sector ideas coming through in both the food sector and the transportation sector, and it's going to be interesting to see how those play out in the sort of weeks and months ahead. Now, before I close the episode, there's a couple of things that I wanted to point out in terms of updates on what's going on at the Institute. So firstly, Raj here is hosting a live seminar event in New York on the 7th of November called Lossaholics Anonymous. Some of you may remember from the last episode of What's on Your Mind, I also talked about a similar event happening in London. That's been and gone now. But I'm sure that for those of you that attend this one in New York, Raj is going to do his absolute best to try and curb any addictions that you may have to losing money in the markets. But in all seriousness, it's going to be a fun one, so do try and attend if you can. The second one I wanted to mention is, as well as that, we've got a brand new webinar coming up, which is an alumni-only webinar, meaning that you can only attend if you've taken one or more of our courses before. That's hosted by Anton Creel and Ross Williams. The subject matter is bond market indicators. So it's going to be a great webinar to supplement all the material that you've learned in our courses online as well. And that's all I wanted to point out, really. That was on the 16th of November. Don't forget that also, if you're just looking to keep up to date with what we've got going on at the Institute, or you're looking to learn more about trading and how to manage your own money, then you need to start by just visiting our website and checking out all the resources that we have available there. So anyway, that's it for this week. Catch us next time for another episode of What's on Your Mind.